Hello and welcome back to another weekend deep dive. My name is Justin, and this weekend we're going to try to figure out what is happening with the S&P. Are we completing a W pattern to go to new all-time highs, or are we going to fade and lose the 430 and 420 area? I apologize ahead of time if the audio or video is not 100% this week. I'm not at my normal station and doing my best here. If you guys wouldn't mind clicking on that button to make the thumb turn blue as we start the video, that'd be greatly appreciated. So, as we're getting started here, we're just going to start with the seasonality chart because this is where we picked up last week. So what we can note here is that we got 1, 2, 3, 4 tops and then a W forming. So far in the SPX, we got 1, 2, 3, 4 tops and the W formed. So the question is now, are we going to hold that low or are we actually going to lose it? And we can look at a clean chart here for the seasonality chart and just see that, again, 1, 2, 3, 4 tops. There's our W, there's the lower low, and we should be advancing from here. So we're looking for this low at roughly, I don't know, about the 10th of October. We're currently recording this on October 2nd. So if we're currently tracking, we are about 1 week ahead of schedule. If that's the case, then we don't have to go any lower. If we've not put in the low yet, I don't know where we're going to go. Maybe lower, maybe below 420. So that's it. As a stock market reset, we're going to try to answer that in this video. So there's a few headlines we're going to look through here, one from CNBC, one from Bloomberg, which ironically are talking about the exact same thing. So the question is, has the stock market reset? The market slide is probably temporary as valuation investor sentiment undergo a great reset. And the second article here is from Bloomberg, and it talks about a lot of the same things. I've been mentioning this on the streams during the week, but Bloomberg is summarizing it here really well for us. So traders worry about another ugly close even as U.S. stocks soar. So what's missing here? Late day weakness has been pronounced lately. We've not really seen very many rallies into the close. We can look at this image right here, and it becomes very obvious. We can see that the green line signifies September 30th. The yellow line signifies September 28th, and that is Tuesday and Thursday. So we can see here that going into the end of the day, into the final hour, we've been getting a sour reaction. So Tuesday, Thursday, we saw a big dump. The black line here is going to be the average. So we're not really seeing any move higher into the close. Only really happened on one day, which was the 24th. So it doesn't look great. Not going to lie. This does not look really nice. So at a high level, that's what we're looking at. We're going to go through our normal schedule and try to answer everything that we need to know for the week ahead in about 30 minutes. We're going to go through our S&P summary, the heat map, options chain. We're going to go through an economic calendar, ETF review, market moving news, and then finish off with some charting. Here are our high-level notes for this week. Well, we've actually forgot to do that. Weekly notes. What we got here so far is that there's still no alternative, but what do we do? Do we hold cash? Do we put our money in the market? What do we do? That's the big question. QQQ drag on SPY, so making SPY catch up to the broader market sell-off. We're going to have a look at that as we look at the charts a little bit later. We got non-farm payroll on Friday, and we also have China reopening on Friday. Why does this matter? Well, Jerome Powell told us that we don't really need a blowout jobs number for him to have the mandate met for actually tapering. That's really important. I have another article here from Al Arian, who also signifies that. Again, that is Mohammed Al Arian. We'll look at that in a moment. October 18th happens to correspond with two catalysts here. First of all, we got the debt ceiling, and then also we got options expiry, monthly OPEX on October 18th. Evergrande also corresponds with roughly 3 weeks from today, which is going to be the third week of October. Again, only about 20 billion out of 300 billion is having an issue there, but there was some debt contagion that actually spread over to Sweden. I don't want to focus on that for today. We're going to be focusing on the US market. And I forgot to do these notable events, so we're just going to skip that for now. All right, let's jump in. So I think where I want to start is actually just doing a quick S&P review. And then I actually want to look back to last weekend's notes because I think that it's important for us to understand where we're coming from to know where we're going. So first thing we're going to look at here is just the broader S&P analysis notes. And again, you can find this under the SPX channel in Slack. If you want to learn more about that, click on the link in the description to learn about our free trial. First image here again, we're going to look at the monthly chart. So I've done some re-analysis here just because we're opening up a fresh month, we're opening up a new quarter, and we're going into Q4, final quarter of the year, usually a holiday Santa Claus rally. So we better make sure we're on track. Otherwise, we better make sure we know what we're doing. All right, so we got a big red price move lower for September, but there is a lack of volume to convince me it's real. We got 428 as a pivot as we open up the new month here, so we can clearly see that the red bar is big, but it's not huge. So I didn't really call this a convincing sell-off. It's just a huge price action move lower. We also don't have a blow-off top here, so I think that the market's only going to blow off when we actually have greed in the market. And right now, there is almost no greed. People are actually very fearful right now. We're just teetering between extreme fear and fear. So we can have a quick look at that. Let's just look at that dial really fast here. So we were in extreme fear on Thursday. We ticked up 2 points to about 27 to fear on Friday. The market has not been greedy for a while. Only greedy about a month ago, and then right back down to red. We've been fearful for the last year. And as a reminder of why that matters is because when we look at the last 12 months or the 1 year performance, it's pretty hard to argue that the market's not done well. It's gone really, really, really high. There's a lot of names that are doing really well. Some pockets are red, but the broader market theme here is green on the screen. So if people are scared and the market went up anyway, can we do the same thing this time? That's the big question. All right, flipping back to here. So there's a lot of really important levels we have to watch for now because, again, new candle means we got new levels. First of all, what it looks like here is that we have a head and shoulders on the monthly chart. So if we can't get back above 438.5, looks like it's confirming here. Head with 2 candles and then a shoulder with 1 candle. So again, lack of price to convince us it's real. We got 428 as an initial pivot. See if we can advance. We must claim 436.1, which is our low from August, and we must also claim 438.5 to begin invalidating the bear move. We've lost the first uptrend, but we're holding the second one here. So going off of the low in, I believe that's April, we lost it, but going off of the low from June, we're holding it. So this is very similar to the uptrend that I have for the weekly chart, but again, just looking at it on a monthly perspective. So what does that mean? I've added a funnel here. It shows we cannot lose 421 into October. Otherwise, I think the stock market rally's over. So that 421 is really important. Remembering that, that's only really for the close. We can get a wick below that, but we can't close below it. That's the really important thing here. We would be invalidating the seasonality chart, the liquidity-driven rally, and we would be breaking bearish with multiple lower highs and lower lows. That is the sign that we're likely going lower. Where can support be found? Well, if we don't go higher, we have to know where are the areas to hold. Why? Well, we got a lower low so far. So if we're not going to make a higher high or get back above 452, 454, we just got to make sure we know where the support is. So sitting here at 434, but getting massive swings on a daily perspective, we got to probably have a big range for our support and resistance this week. So looking at the monthly chart here, we can note that we got 428.88 as our July open. We got 428.06 as the June close. We got 422.06 as the June open. And we got 421.97 as the July low. So all that means is that we're pretty much digesting all of the moves from July and June. That's really important. Looking here to our weekly chart, sorry, that's the monthly one. Looking at our weekly chart here, again, very clear to see that we hit the top, hit the top, bottom, top, bottom, top, bottom, top, bottom, top, bottom. So we haven't really touched the bottom of this uptrend for a while. Here we are. We touched it twice. What's notable here is that we have an uptick in volume. So again, volume is ticking up. We got about 500 million shares traded this week. We got a lower high and a lower low. What that means is that it's actually diverging from most ETFs, which made a higher high and a higher low this week. We'll have a look at that in a moment as we go into the deeper dive of the charts. SPY is catching up to the broader market declines. What does that mean? Big tech fade. So if we have a look here at the heat map again, I know I have it summarized in a different thread, but just to show you really fast here, it's very obvious that in the last 1 week or the last 7 days, we've had notable weakness in healthcare other than Merck and tech, right? Financials are holding up, energy's holding up, and we will note that in the other thread as well. So again, just noticing that tech is pretty much selling off altogether. Tesla actually just had news that came out that they actually beat their Q3 deliveries. So maybe Tesla's going to lead, but everything else is really soft here. So not seeing signs of strength, not fantastic. So the weekly chart tells us that, right, uptick in volume, lower high, S&P is catching up to the broader market sell-off. So big tech is going to be in focus for me as we go into this next week. There's also some clues on the QQQ options chain. Looking here at the daily chart for S&P, we're going to look in a moment at the option chain, but looking here, we can note that we got 2 different charts here. So the first one's going to be for the daily, both are for the daily chart. One is zoomed out, going all the way back to early 2020. The other one's zoomed in, so we can focus on the short-term uptrend. So again, we're looking at this uptrend on the closer time frame, and on the other one, we're looking at the all-time high connect here. So back inside the pennant. So again, we're back inside this triangle here or a pennant, which means that we're range bound. Technically, we closed below it for 1 day. We opened up on the uptrend. We pushed lower, pushed up, sold off into the close. So 428.86 is the gateway for the bulls. What that means is that if we're going to respect that seasonality chart with the W, we cannot fall back below 428.86. Otherwise, that's really bad. It likely means the bears are in control. And then again, 422 to 428 would be on deck. We have to hold for the seasonality chart to remain valid. It doesn't have to hold right now. It has to hold into roughly mid-October. So again, really important for us to decline down to the 700 option clue. We need to basically come back down to the all-time high connect, which means we're going to need an even greater reset of the stock market. That would be very negative. Coming back down to 400 is going to mean that how green on the year would we be actually with that? Where did we close out last year? Let's go to SPY actually, just because I know those levels better. We closed out at 371. That's right, 373.88. So 373.88 to roughly 400. Ugh, all right, that's only about 7%. It's not terrible, but oof, that's not going to be fun. All right, moving forward. All right, so what we're looking at here is just that we can't be oblivious to the potential for a downside move. There's a lot of puts. I'm talking at every $5 strike from 440 all the way down to 395. So if we hit 400, it doesn't mean we're bearish yet. We're actually going to be losing the 200 DMA, but bouncing off the 261 Fibonacci extension from our October high to October low, and also the gap that we've left here. The gap is at 400.67. So pushing down to 400 would actually fill that gap. But again, make some substantial damage on the chart. Looking here from last week, we'll go look at those notes in a minute here. We only managed to actually get our head and shoulders at 447 on the ES1, which is the futures. So we can note here that on this candle right here, we can see that we now have our head and shoulders pattern, which is visible on the daily chart. And as we noted, it's also visible on the monthly chart. So looking here, we only managed to actually hit this in the futures market, which means that I think this is on Monday. There was a German election, and they gapped it up and then faded hard. So when we open up the cash market in the US, we were actually only down at about 444, right, 440. So we didn't actually quite make it up to the 447 on SPY. And we can see that here by just looking at the daily chart and seeing that we only really managed to hold the 50 DMA for 2 days and then fell right back below. ES pushed up to roughly here. So pushed up to roughly that 447 neckline that we were looking at for the head and shoulders pattern. So all this means is that technically we got our head and shoulders pattern, which we were looking for into Wednesday to validate the bear thesis. So again, technically we got the head and shoulders here and we did fade after that. So look at the hard rejection off the 50 DMA, dead cat bounce, rejection at 4375, and now chopped up, right? Volume's really ramping up too. Looking at the hourly chart, we get some extra clues here. So this is going to tell us that we're going to need over 436.1 or that monthly low that we referred to earlier to have any signs of strength. Otherwise, we're likely going for a fresh fade or a fresh haircut. So finally, here we got 431.5 as a bear apex into Friday. So with that non-farm payroll coming out on Friday, it's going to be very important that we are above 431.5. Very, very, very important. Lastly here, we went through the seasonality chart. So looking here, historically, September is a pretty sour month. So again, normally it's one of our reddest months of the year. And October actually snaps back to close out green. So we should reverse all the losses from September and October. If that's the case, we better start making sure we go now. Why? This pattern is now complete. If it's going to become invalid, it just means we're going to push lower. So this is what it looks like here, right? Tick, tick, 4 ticks up, 4 ticks up. W was formed into early October. All right, we're about 15 minutes in here. Let's move forward. I want to go through a couple of articles really fast because these help summarize my my analysis here. And then we'll look at the options chain, but again, it's scary. So we'll look at that in a moment here. Traders worry about another ugly close, even as US stocks soar. So here we're talking about dip buyers where they're just not showing up. Late day weakness has been a recurring theme, Jacobson said. A derivative strategist wrote in a note. Given the role that investors have attributed to the buy the dip mentality in supporting the rally over the last year plus, we find the recent trend worth highlighting, even if it ultimately proves to be a short-term lived anomaly. We had 4 out of 5 days this week, which were options expiring. And again, that's important. We did see a big ramp into the close on Friday, but I think that's largely due to options. So we'll have a look at that in a moment here. So buying the dip was such an investment strategy for so long. Now those investors are more likely to be nimble, stay on the sideline a little bit longer. They're more willing to be patient and ride this bout of volatility, and they might be waiting for volatility to pick up even more before the dip buying again. The recent uptick in volatility, I'm just going to skip that part there. So that's the theme, right? We're not really seeing the bull show up. It's not a great sign. The market slide is probably temporary as valuation investor sentiment undergo a great reset. I would summarize this by saying there is still no alternative. Where are we going to put our money? Making money does not go out of style. People still want to make money, but we don't. All right, let me just make sure I'm still recording. Sorry about that. Looks like my Bluetooth got disconnected, and hopefully this video did not get messed up. We're going to go forward here. I'm just going to assume it's working. So again, if you guys wouldn't mind smushing that thumbs up to drop me some support, and at the same time, drop me a comment. What are you guys thinking this week? Are we going up? Are we going down? Or all around? All right. All right, let's have a look at this one here. So now again, they're quoting that 5% decline. We technically already had it from peak to trough, but on a closing basis now we have it. So here they're quoting that the 5.2% decline in the S&P 500 from December 2 record high through the end of the month, Thursday, narrowed by Friday's 1.2% bounce, was a headline index succumbing to an undertow that has been dragging on this market since June, when cyclicals and reopening stocks peaked. I don't know if that's true, but again, this is what they're saying. Now that the index has caught up to the typical stock, the S&P 500's year-to-date gains now perfectly align with that of the median stock as gauged by the equal weight Russell 1000, up to even 16%, up to an even 16%. So I'm going to jump to another article, then we'll circle back to this one here. I'm going to look at this one here first. We reviewed this one about, I don't know, like 3 weeks ago. Big updates are gone as corrections hit half of the S&P 500 stock. So market and longest drought of single one-day gains in 20 months. Tech can't be the crutch forever, Morgan Stanley's Wilson says. What happened? Well, we're getting big moves down and big moves up. We've had a couple of 1% days, but the volatility is definitely back, and the big cap tech stocks are definitely what is dragging us. Big rallies are the thing of the past, as we noted, but I want to jump down to the graph here. So let's have a look at this graph, and it'll show us the story. The story is pretty clear to me. The story here is that the S&P 500 has remained durable, but damage has been done under the surface. So we can see here that this is the percent of members with a max drawdown of more than 10% since May 1. We can see that, again, this is from about 3 weeks ago, so I'm sure these numbers are higher now, but 100% of energy stocks did hit that peak to trough of 10%. Materials, discretionary financials, all pretty much did it. The only things that didn't really do it were utilities, real estate, healthcare. Healthcare now picking up and actually tanking, and S&P is now actually finally catching up. So all that means is that we're seeing that tech is now actually dragging, and we're seeing this happen here, right? Helping keep the market afloat are tech giants Facebook, Amazon, Inc., Apple, Microsoft, Google, a cohort known as the FANGs. Without the five, the S&P's 4% advance this quarter would have been halved. So when the market declines from big tech, it's very obvious here, right? Down minimum 3% a piece here. I'm sorry, Facebook a little bit less, but down the previous week. All right, moving forward. What do we got next here? Let's go back to our article. The market has been supported since the spring of 2020 by steadily rising corporate interest forecasts. So while the S&P often are running a bit ahead of the consistent profit target. So here we just see that the green line is going to be SPY, the blue line is going to be the forward 12-month EPS or earnings per share. So again, looking out to the future. The big question is going to be what is going to happen as we go into this next earnings season. It's going to be very important. Why? Well, if we start to see that forward guidance starts to come flat, starts to flatten out, S&P might take that clue to sell off ahead of it. So if we're doing a reset here, again, there's the bull and the bear case. They both have equal weight here. Major win streak reset. Right, finally got that 5% pullback. A 10% would be a correction. So far it's just a pullback. There's a lot more stuff inside of here. I've already shared this in Slack, so I'm not going to really do it. Here we go, right? Missing dip buyers. So similar to what Bloomberg noted, I noticed it too. After going 10 months without spending more than a day under the 50-day moving average, the S&P has spent 2 weeks beneath it, excluding 2 days. The urgency of dip buyers is apparently dissipated for now. Late day weakness has been the rule lately, and a switch from most of this year. ETF inflows have not emerged after big one-day drops in the indexes and the way they had in prior months. So again, what I kind of think, and when I'm looking at this, what I'm kind of thinking is that retail might have blown their wad. And what I mean by that is they love buying out of the money call options. So if they don't have any money left to buy calls, the market makers are not forced to actually buy the underlying asset to cover the exposure. What does that mean? Without out of the money call buying, the market is not as motivated to squeeze higher. There's not that gamma squeeze. So I think that as everything goes back to normal, people are going back to work, the market is starting to look a little bit more normal. We're not seeing that over exuberance in options, which has been driving the market higher. So now I think that the move that we're getting here is actually just to scrape the put flow. So I think that we're gonna have to see inflow starting to come back in for us to actually have a sustained move higher. All right. So lots of talking so far. Let's move forward to our next thread. I'm going to go to last weekend's notes because I think that as we jump to the next section here, it's really important for us to just understand where we came from last week. So I just want to jump down to a few things here. So let's go to our daily chart where we were looking for a range of 436 to 447. Clearly, we lost that. We punched down to 420s again, put in a lower low, and we failed to hit that 447 neckline as I pointed out on ES. And the monthly chart is now actually showing us that head and shoulders pattern. Until Wednesday, we had clues that we were not at 447. We were actually about 12 points lower. We were sitting at 435. So it's starting to confirm that head and shoulders. It confirmed it. Last thing I would just note here is that we were talking about the seasonality chart having two options, option one and option two. So option one was that we kind of finished the dip and we were going to go higher. So sorry, this was option two where we advance off the 50, break the head and shoulders at 447, and then advance to new all-time highs. Here we noted that if we fail at 447, we likely go to complete the W. The W is now pretty much completing. So we look back at SPX here, the W is now formed. So the question is now, is it going to hold? So that's where we are. We're back to option one. Option two is now void. All right, moving forward. Now I'm going to go through my supporting evidence for this, for the SPY analysis. So we're going to have a look here at the calendar of events. We've already talked about some of these things, but there are some big data points this week, notably non-farm payroll. Really, 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 really important. It's going to be coming out pre-market on Friday at 8:30 a.m. And as we look at the options clues in the next section, we're going to see why this matters. I would note here that China is going to be closed on Monday, Tuesday, Wednesday, Thursday, but reopening on Friday. So whatever happens with the broader market is likely going to feed through to the trading on Friday for China. And we know that, again, it's been a complete joke over there. So what's going to happen, I don't know, but it's probably going to have a bigger effect because 4 days of being closed on non-farm payroll, I don't know, right? It's going to probably really matter this week. Other things we can pay attention to here are pretty much just two more data points. ISM non-manufacturing PMI on Tuesday. Again, it is not going to be as important, but it's notable. ADP non-farm payroll will be a clue for what we can expect on Friday. But remember what Powell said. It only has to be an inline report to say that we've met the mandate for raising rates. We don't need a blowout jobs number. If we get roughly in line or even a little bit of a miss, I would say that is good enough. We talked about this article. We talked about the Bloomberg one. And there's even more turmoil at the Fed where looks like clear to trade into stocks on the eve of Powell pandemic statement. What does that mean? He traded between $1 and $5 million out of bonds into stocks. Apparently, this was pre-planned quarterly rebalancing, blah blah blah. But again, we saw what happened with who were the two people who stepped down? It was Rosengren, and we saw James. No, it wasn't James Bullard. Who was the other guy who stepped down this week? I forget. It was the St. Louis Fed head. So he's the vice chair. This is really bad because it makes the Fed look like they're trying to front run the policy statements, and it's not a good look. Last thing I would note here, which we did not actually talk about in the last section, is the L. Arian headline here. So this is going to likely really matter. L. Arian is a very respected person in the market, and just yeah in the market. So L. Arian sees Fed risking disorderly taper without quick action. The window is closing to avoid disruptive markets. I would agree with him too. His major points are very valid here. The bond market influencer, blah 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 blah. When it comes to an orderly taper, the window is closing. Um, he pointed to the U.S. housing market to make his case in speeding things up. We're still buying 40 billion of mortgages every month, he said, referring to the Fed's emergency liquidity injections introduced early in the pandemic. The problem in the housing market is not that is not that it needs support. It's that it's pricing out Americans. Americans can no longer afford what's happening in the housing market, and the Fed is helping to exacerbate that issue. Record prices increases and blah 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 blah. We're still buying 120 billion of assets every month. What we have been buying since the worst of the COVID crisis, he added, referring to the Fed's overall asset purchase program. Does it make sense in this environment when the demand isn't a problem, when the bond markets are wide open? It doesn't really make sense for me. So they need to start tapering this down. And if that mandate is met on Friday, we're likely going to see some movement here. All right, finishing up. Last thing I would note here is that, again, just look at the date here. Yellen says U.S. may exhaust cash by October 18th, barring debt ceiling raise. So again, this happens to correspond with monthly OPEX on October 18th. So the data is double important. The reason why it's going to be double important is because if we don't see any progress from the government going into October 18th, there's a reasonable assumption that we could sell off into it. And again, we got the government shutdown avoided on Thursday night, but this is a very bad look. So just paying very close attention to this. All right, moving forward to our next thread here, we've got options clues. And jumping forward to here, sorry, there's noise in the background. I apologize about that. I'm just looking to here for our week, our options chain for next week. We've got 3 here. We got Monday, Wednesday, Friday. What I would note here, as I noted earlier about the move higher into Friday, is that I think this is largely driven from put flow. So we can look here to see what's happening on Monday. And 434 looked like it was max pain going into the close. Why? Well, there was a whole bunch of put buying from 434 all the way down to 427. So this looks really bad. It looks really bad just because people are very eager to buy puts. Tons of options flow. The premium got absolutely crushed here. And the last thing I would note is that we see 440 call buying. There's open interest and there's volume. So I'll be tracking to see whether or not this actually reduces the OI or actually increases it. Looking forward to Wednesday, we can note that there's call buying just in volume at 435 here. And the other thing I would notice that we got 430 and 428 call spread. Put spread. So I'm not sure which way it's going to go, but the big moves are largely concentrated into Monday and then Wednesday. So Friday here, the note says that it looks very similar to Monday, where we got, we see from 432 down to 427. And then we also have, I didn't show it in the screenshot just because it's not on the 16s, which means the 8 strikes above and the 8 strikes below. But it shows here that we also have about 38,000 in volume at 420 put with 20,000 in open interest. So same note, I'll be looking to see whether or not the volume converts into open interest or actually reduces it. Jumping forward here to October, we can note that we got a 440 straddle. We got a 440, 430 put spread. We got a 450 naked OI. And we got 450 to 395 puts at every $5. Why does this matter? Again, as we noted, this is going to be not only the government shutdown, but it's also going to be the OPEX. So again, just looking forward to here, we can note that, just look at the numbers. So when we looked at this last week, just one second. All right, sorry, just getting distracted here. Looking here, we can see that in October, we got the 440 spread. So this was not what we had the week before. So the numbers have now been bumping up dramatically on the put side. And what we note here is that the 440 straddle is still here. We can note that we got about 860 in premium on the put side and about 280 on the call side. So we're looking at about $11 in premium-ish, maybe 11, 12 bucks looking at that. So that's still below 430 or above 450. So basically all-time highs or breaking the seasonality chart to go bearish. Sorry for the noise in the background. Trying my best here. Looking forward to here, we can note that we got 440-430 put spread. So again, here we got 90,000 in put open interest, and we got 100,000 here in open interest at 430. Big volume coming in at 430. So again, I don't know. People are really positioning here. I know screenshots that go beyond the 16s to actually show what's happening above and below. So here we can note that we still have that big fat stack at 450. We got 400, sorry, we got 228 open interest for calls here. And there's volume coming in too, but this number's been increasing. So they're not conceding on this fight. What I would note here is that we are seeing the put flow coming in at every $5. So 450, 445, 440, 435, 430, and then continuing even lower. Here we got 425, 420, 415, 410, 400, 395. So these numbers are huge. This is billions and billions and billions in dollars in premium. So again, 40,000 here at 450. It looks like it might still be a straddle, not 100% sure. 50,000 at 445, 90,000 at 440, 50,000 at 435, 100,000 at 430. So the other thing that's really important here regarding that 430 area is that the last couple of weeks, as we were looking, the 445 straddle had a break-even price of either below 430 or above 450, so 460. So that's really important as we have a look here. And the premium on these is still pretty high for us only being about 2 weeks away from expiry. So even looking down to here at about 425, they lost about $2 in value, but they're still worth about $3. So that implies 420 break even. As we have a look a little bit closer here, we can have a look at a level like say 405. These even still have about $1 in premium, but they've deleted about half. So my question is this. The big move higher that we had into Friday, I think, was that they were trying to just make sure they don't pay those out. There was huge put flow for Monday, Wednesday, and big time on Friday. And then October monthly had huge flow. So this move right here might just be them actually going in and closing out some of the exposure they sold earlier this week. So I just want to see if these numbers actually get bigger or smaller. But again, there's a siren here. Why? It's very notable. Moving forward to our SPX reports, which show what is happening on the market makers. So again, what are the biggest top 25 indices that are purchased in terms of strikes? And the only ones that I noted here that were notable were activity on Friday. I'm looking at the activity from Monday all the way through to Friday. And what I note here is just that we're noting that they bought for October. I also notice this number right here, right? Oh my God, what's going on here? 65, 67, 6,800. These are for December of 2023. And there's not a lot of premium attached, but the numbers are just notable to me. Like, who's buying this? Who's buying like basically 65 to 6,800s? I don't know. It's notable though. I'd also note here that we do see more activity, not going into October 18th, but to October 30th, October 29th, sorry. So here we can note that we get multiple stacks that are going for 28 days to expiry. And we note here that we got a 4,200 spread. Straddle, sorry. And then we also have just random ones here. These look like put spreads. We got 43, 4,100. Then we got 32 and 3,800. So it kind of looks like people are buying and selling spreads, put spreads. That's the theme here. Looking forward to our next section, we've got the options flow. So lots bought this week. However, the second screenshot shows us that these are sorted by premium here. So these are $250,000 orders or more, right? It's notable. Looking at the second screenshot here, what we can notice that there's a lot of puts bought on Thursday for October 18th. So what we can note here is that these were purchased on the 30th, and again, what happened? Sell them on Thursday, burn them on Friday. That's what it looks like here. So these are the only ones which are still which have still not expired. So on this screenshot here, again, we can see that a lot of the stuff was actually for the later part of last week. Looking forward to here, it's pretty dense. So what is not expired yet is pretty concentrated in that 420 area that we noted on the chain we just looked at. 420 with 380 in premium. Note the spot price these were purchased at too, 434.2, down to 430, 436. Where did we close on Friday? 434.2. So sell the puts, burn the puts. Why? Well, again, look what they paid here. They were paying about $4.50, $4, $3.50, $3.80, right? So call it roughly $4. We can go back up to our October monthly chain, and we can look here at the 420 put and see they're worth about 250 right now, right? 250 right now, right? What did they do? They torched them. They burned them so nice. So they did a great job here. So what this might mean is that they sell the options, they burn the options before letting it actually go the way that it was originally going to go. So sell the premium, burn the premium, let it happen. All right, moving forward to QQQ. We can see similar activity here. lots of activity. It's mixed. It's roughly neutral, but what is not expired yet is definitely skewed bearish. We can note here that we got 360, 358, 357, and notable, and those are all going to be expiring by next Friday. So again, lots of money flowing in here, and not sure what's going to happen. But when we look at the just the chains now for QQQ, we can note that on Monday we got 360 max pain. Where did QQQ close on Friday? Oh my goodness, closed at 360.18. Again, I'm seeing evidence that also tells me that on QQQ, the move higher on Friday was just to burn the premium. Why? Well, at the money to, I don't know, about 10 points out of the money, we see put flow at every level, everything red on the put side, everything red on the call side. These guys are pros. Looking over here, we see a little bit of activity with 358 and 360 call spread. And again, closing out at 360 means that these get fully cashed up and these ones don't pay out. So, right, they're great at their job. They're really good. Looking forward to Wednesday. There's a big stack here at 350 put. I'm thinking this is related to the ADP non-farm payroll number we're going to be getting pre-market. And then moving forward to Friday, we can note here that we got 350 put continuation. Same dollar value, but it's just half the volume because the premium is half. So here, looking out to Wednesday, we can see that we got 40,000, but these are worth about 65 cents. As we have a look to Friday, these are worth $1.30, so 65 cents times 2, and about half the volume. What does that mean? They're bearish into Wednesday with continuation into Friday. Where would we have to be for these to pay out? We'd have to be below 438.5. So 438.50 would be the break even for these puts here. For Wednesday, for Wednesday, we're looking at roughly 349. Finally here, looking at QQQ monthly, we're seeing similar activity to SPY, but it's also notable that there's actually a straddle with equal put and equal call open interest. So here we can note that we got the 375 straddle, so 63,000, 62,000 in open interest. There's no volume, which means that they're holding on to this. They're going to try to pay both sides out, just going to settle for one. I don't know. Looking at the premium though, 15 bucks and 60 cents. There's no point in covering these out because they're only worth about 60 cents. But what's notable here as well is that they've deleted about $2 in value from the puts and only adding on about 2 cents in premium to the calls. What does that mean? The option buyers are losing money. Notable here that, again, we got 50,000 plus stacks at pretty much every level. 365 is a little bit lower, but I would consider that about 50K. So we got 60 every $5. So we got 63K at 375, 62K at 370. This looks like a spread. And then looking here at 365, we got 40,000, 360, we got 50, 355, we got 50,000. So this also looks like another spread here. All right, I think we're almost done here. I think that covers off most of the important things we want to have a look at. Video is a little bit longer than normal, about 37 minutes, but it's a really, really, really important week ahead. I don't have my S&P levels quite prepared yet, so I'm gonna have to finish off my notable events. The dollar, right? Dollar's been definitely advancing as well, and this is pretty much on cue for what we had from before. I think I'm going to leave the video there. What I would really appreciate as we're signing off here would be a thumbs up, and please just make sure to drop me a comment. We're definitely going to be volatile this week, and if you're ever feeling uneasy, we do a market video every day of the week. So we do a stream to support you at 9:15, and maybe we're going to do the lunchtime updates again this week as well at 12:15. So if you need some extra help this week, I would consider smashing the thumbs up, subscribing to the channel, and also just tuning into Blaze Capital. I forgot to do something too, so I didn't actually prepare about this. I want to thank you guys for getting us to 1,000 subscribers on this channel. We were going to do a giveaway. I did not have it prepared, so tell me in the comments, what prize should we give away for next week? I will consider giving away what you guys tell me. Thank you again for tuning in, and I look forward to seeing you this week.